coming in from the Fed chair. Joining us now to talk more about this, James Knightley, the Chief International Economist at ING, as well as Jahangir Aziz, MD and Head of Emerging Markets Economic Research at JP Morgan. Good morning, gentlemen. Thank you so much for joining us live. James, let me come to you first. So we know there's going to be tightening. The Fed is going to do all it can to rein in inflation. We've already seen bond yields jump to 23-month highs. If I could begin by getting your initial comments on the commentary that has come in.
Yeah, no, it's been an interesting session, really, in the US. We've seen this big announcement. Well, it wasn't big. The press conference and the press release itself was very bland. It was pretty much in line with expectations. It was really Jerome Powell's comments in the press conference that followed that got all the excitement really kicking in, where, you know, he sort of basically said all meetings this year are live, and we could conceivably see interest rates rise at every meeting this year. So the markets, you know, which were sort of pretty happy pricing in 4 interest rate rises worth a full percentage point, now suddenly thinking, well, actually, you know, we may end up going a little bit further, a little bit faster than this. And I think that's really the key takeaway, is that, you know, we've got to be mindful that the Fed is now really playing catch up on the inflation story and could end up being far more aggressive than we've been thinking just a few weeks ago.
So Jahangir, taking forward that point, since we don't know the number of hikes that will take place or how big the hikes are going to be, and we've seen those reports coming in whether they could be just 3 or just 4, but as the Fed comes out with these kind of commentary, what's it going to mean as far as flows go, especially with an eye on the Indian market?
Look, I mean, I agree with James. I think what really upset the market was not the policy statement, but what press conference of Powell, where, you know, it is no longer a case of a hike every 2 meetings, but it could be have a hike every meeting. We already have 4 hikes for this year and 4 more for 2023, and that's not the terminal rate. The terminal rate could be much higher. And as James pointed out, you know, we could actually see the Fed move much faster. Now, if you look at what drives capital flows into emerging markets, there are 2 major drivers of that. You know, growth differentials, and emerging markets aren't doing very well relative to the US in terms of growth differential so far this last year, and it is going to be a tight race this year. So you're not getting very much support coming from widening growth differentials in favor of emerging markets. The other big driver of capital flows into emerging market is what happens to the dollar. And thankfully, the dollar hasn't really reacted that strongly to the rate hike cycle that has been announced or that's been anticipated. Interest rate differentials do make a difference, but interest rate differentials make a difference at the long end of the curve rather than the short end of the curve for emerging markets. I'm not talking about, you know, euro rates versus dollar rates, but I'm talking about emerging market rates versus US rates. It is much more on the long end. And the long end of the curve, which is the 10-year rate, the 10-year rate hasn't really, despite the repricing and the correction of valuation that has happened with the 10-year rate in the first 2 weeks of January, the 10-year rate really hasn't reacted that much to the announced aggressive tightening by the Fed. And I think this is where there is a difference between what the Fed or what economists or how economists look at monetary policy versus what the market is looking at. So if you look at the market is saying that the tapering and the quantitative tightening that is going to follow is a substitute for rate hikes. Consequently, you know, if the quantitative tightening is, or the runoffs, as it's called in Fed language speak, if the runoffs are going to be very large, then the rate hikes will be that much less. But which means that the effectiveness of rate hikes on lending rates is that much less, and that will force the Fed, ironically, to move even more aggressively if they are trying to use this instrument to curb demand and therefore curb inflation. And I think that the Fed will need to address this issue at some point in time to clarify that the quantitative tightening is not a substitute for the rate hikes. But as long as that remains entrenched in the minds of the market, my guess is that you're not going to see a very large repricing of the 10-year. And if that doesn't happen, then at least one headwind will not be working against emerging market flows.
Point taken. And in fact, speaking of the impact that it had on the US dollar, that rose to a 5-week high after the Fed policy decision. You had the Treasury yield as well hitting a 1-week high of 1.8%. But James, just coming back to what this could possibly mean in terms of the economy, is this an indication that definitely the economy can absorb these kind of rate hikes? And would you believe this indicates for the bond markets?
Yeah, well, certainly that was the key takeaway from Jerome Powell, that he does feel that the economy can withstand much higher interest rates. And certainly this can happen without a material impact on the jobs market. I mean, we've got to remember there are 10.5 million job vacancies in the United States right now. That's a record all-time high. So there is a lot of demand out there, and demand is rapidly outpacing supply in so many parts of the US economy. And that is indeed why the Federal Reserve is trying to take some of the heat out by tightening monetary policy now. I think they could have perhaps started it earlier, but they're now playing catch up a little bit. And that's why they really are, I think, scrambling a little bit in terms of interest rate rises. Interest rates are going to be the primary tool for tightening monetary policy at the short end. They made that very clear. But I think certainly this quantitative tightening, the unwinding of this massive balance sheet, nearly $9 trillion, is going to be also quite a big contributing factor. I mean, we are starting to see more comments from Fed officials. What is perhaps the aspiration in terms of what sort of size of balance sheet does the Federal Reserve want to hold? And one of the Board of Governors, Chris Waller, a very senior official, has suggested that, at the moment, the balance sheet is nearly $9 trillion. That's the equivalent of about 36% of US GDP, and an almightily bloated balance sheet that the Fed has. Well, he's suggesting perhaps get it down to about 20%. Now, if you assume, that's going to be over a 5-year period, the economy is growing over that point as well, it still implies about $3 trillion worth of assets leaving the Fed's balance sheet and having to be absorbed by the market. And that does, I think, still lead to some upward pressure on Treasury yields at the long end of the curve. We think that is going to help contribute to pushing the 10-year above 2% over the coming months. And we're already starting to see that translating into borrowing costs in the broader economy. The 30-year fixed rate mortgage in the US here has gone from 3% at the end of last year to 3.7% now. So we are already starting to see these higher borrowing costs spread out and starting to hit people in the pocket.
James and Jahangir, appreciate your time. Thanks very much for joining in and assessing the US Fed move and what impact it had on the economy and the global markets.